Her name is Jordan. She's a registered nurse, mid-30s, single, works long shifts at a hospital 30 minutes from the modest home she rents in a quiet neighborhood. Every 2 weeks, without fail, the moment her paycheck hits a portion goes directly into savings. Has been doing it for 11 years at the same bank. Same checking account, same savings account. Never overdrafted, never missed a payment, never given her bank a single reason to question her. By every measure, Jordan is doing exactly what she was taught to do. Save consistently, bank responsibly, trust the institution. What Jordan doesn't know, what almost nobody in her position knows, is that while she has been faithfully depositing into that savings account for 11 years, her bank has been quietly using her money to generate returns she will never see. Returns that have helped fund executive bonuses, shareholder dividends, and loan products sold right back to people exactly like her. And in exchange for 11 years of loyal deposits, a free hat, a tote bag, and 0.5% annual interest. My name is Sage. Before I built this channel, I spent over a decade inside the financial system as a Series 7 licensed financial advisor and as a consumer lender at major financial institutions. I didn't read about what banks do with your money. I worked inside the system that does it. And what I'm about to tell you is something your bank is counting on you never fully understanding. Here at Financial Methods, our goal is simple: to give you more actionable financial knowledge in one video than most people get from an entire book on the subject. Knowledge that took years to accumulate inside the system, delivered to you in plain language, right here, for free. Stay with me to the end of this video, because the hidden gems in this one could fundamentally change the way your money works for you starting this week. Not someday. This week. If this is your first time here, hit that subscribe button right now. Every single week, we expose the financial systems designed to keep everyday people financially stuck, and we hand you the tools to fight back. This one is personal. Let's get into it. Let's start with the thing that feels the most innocent: free checking. Your bank offers it, your bank promotes it. Your bank hands you a debit card, a mobile app, a smiling branch manager, and tells you there are no monthly fees, as if they are doing you a personal favor. Here is what they are not telling you. Your checking account is not a service your bank provides to you out of generosity. Your checking account is the mechanism through which your bank gains access to your most valuable financial asset, your deposits. The moment your money enters that account, it is no longer sitting in a vault with your name on it. It is immediately put to work generating returns for the bank. The free checking account is not free. You are paying for it every single day, you just aren't receiving an invoice. And then there is the merchandise, the free hat, the branded tote bag, the coffee mug with the bank's logo on it. I want you to think about what that merchandise actually represents for a moment. Your bank earns, conservatively, hundreds of dollars annually from the activity your deposits enable. And the thank you gift for your loyalty and your trust is a $4 hat with their name on it. That hat is not generosity. That hat is the cheapest possible price your bank could pay for continued access to your money. And millions of middle-class Americans wear it proudly. The hidden gem number one. And this one will make you look at your paycheck settings differently. Your bank doesn't just prefer direct deposit. Your bank is in an aggressive, highly competitive war with every other bank in America to capture your direct deposit. And right now, the number one weapon in that war is cash. Walk into any major bank today or visit their website and you will find checking account opening bonuses of $200, $300, sometimes $500 or more. The offer looks generous on the surface. Open a checking account, set up direct deposit, reach a specified deposit threshold within 4 to 8 weeks, and the bonus hits your account automatically. Here's what the fine print does not say. Banks know with statistical certainty that once a customer establishes direct deposit at their institution, the overwhelming majority of those customers never leave. The friction of changing banks, updating direct deposit with your employer, moving automatic payments, getting a new debit card is significant enough that most people stay put for years, sometimes decades. That $300 bonus is not generosity. That $300 bonus is a customer acquisition cost, an investment the bank makes knowing it will earn multiples of that amount from your deposits over the years that follow. Banks are competing this hard against each other because direct deposit is the single most valuable thing a retail customer can give them. Your paycheck arriving directly into their system before you have even seen it gives them immediate access to your funds at the earliest possible moment. The early access they offer you as an incentive, getting your paycheck a day early, costs them almost nothing to provide. But the direct deposit relationship it secures is worth significantly more than any bonus or convenience they hand you in return. It is a business transaction dressed as a benefit, a very calculated one. And that brings me to perhaps the most important mindset shift in this entire video. Your bank is a business, a very large, very profitable business. And like every business, its primary obligation is to its shareholders, not to you. You can bank with an institution for 25 years, perfect account history, loyal customer, model depositor. And the moment you overdraft, the fee appears instantly. No grace, no loyalty consideration, no acknowledgement of 25 years of faithful banking. The moment your account falls below their closure threshold, it gets closed efficiently, without sentiment. This is not personal to them. It is business. And the sooner the middle class treats banking the same way, as a business transaction, not a relationship, the better every financial decision around banking becomes. Now we get into the part that even financially educated people often don't fully understand. And when they do understand it, the reaction is almost always the same. Disbelief, followed by frustration. Here's how the banking system actually works with your money. When Jordan deposits $5,000 into her savings account, she reasonably assumes that $5,000 is sitting somewhere safe, held in reserve, available whenever she needs it. That is not what happens. The United States operates on what is called a fractional reserve banking system. Under this system, banks are required to hold only a fraction of their deposits in reserve and are legally permitted to lend out the rest. Historically, that reserve requirement was around 10%, meaning for every $100 deposited, banks were required to hold $10 and could lend out $90. Here's where it gets even more striking. In March 2020, the Federal Reserve reduced the reserve requirement to 0% for most deposit institutions. 0. Which means the regulatory floor on how much of your deposit your bank is required to hold has been effectively eliminated. Banks now operate based on capital requirement ratios set by regulators, but the fundamental principle remains. Your deposit does not sit still. It moves immediately into loans, into investments, into financial instruments that generate returns your bank captures. Hidden gem number 2, reframe this and everything changes. When you deposit money into your bank account, You are not storing money. You are lending money to your bank. The account balance you see on your app is not your money sitting in a vault. It is the bank's record of what they owe you. You are an unsecured creditor of your bank, and your bank is paying you 0.5% annually for the privilege of borrowing your money. I spent years inside consumer lending. I watched this cycle operate in real time. A depositor puts in $10,000. That money funds a personal loan at 18% interest to another customer. The depositor earns $50 in interest that year. The bank earns $1,800 from the same money in the same year. The math is not subtle, and it is not accidental. Let's put the numbers on the screen and let them speak for themselves. What your bank pays you on a standard savings account, 0.01% to 0.5% annual percentage yield. That is the national average right now for traditional commercial bank savings accounts. What your bank charges on a 30-year fixed mortgage, approximately 6.5% to 7.5% annually. What your bank charges on an auto loan, approximately 7% to 12% depending on credit. What your bank charges on a personal loan, approximately 11% to 20%. What your bank charges on a credit card, approximately 20% to 29.99%. The same deposits that earn you 0.5% are funding credit card balances charging nearly 30% to the same customers. Frequently the same customers who made those deposits. Jordan has a credit card with the same bank she has saved with for 11 years. She pays it responsibly every month. She has never thought about the relationship between her savings balance earning 0.5% and her credit card balance being charged 22.99%. They are the same transaction, viewed from opposite sides of the bank's balance sheet. Hidden gem. Number 3. Long-term customers of traditional commercial banks are statistically among the least well-compensated depositors in the entire banking system. Banks reserve their most competitive rates for new customer acquisition, promotional rates, sign-on bonuses, introductory offers. The customer who has been faithfully banking for 25 years typically receives the bank's standard rate, which is almost always its lowest rate. Loyalty to a commercial bank is not rewarded. It is relied upon. The bank knows you are unlikely to leave. The friction of changing banks, updating direct deposit, moving automatic payments, getting a new debit card feels significant enough that most people don't do it even when they know they could do better elsewhere. That friction is not accidental either. It is designed. Before we go further, if this video is already changing the way you see your bank, hit that like button right now. It takes 1 second and it directly helps us reach more middle-class families who need this information. And if you haven't subscribed yet, do it right now. This is exactly the kind of content we deliver every single week. In recent years, something interesting has happened in the banking industry. Companies like American Express, Capital One, Marcus by Goldman Sachs, and others began offering what they call high-yield savings accounts, savings products paying 4%, 5%, sometimes higher in annual percentage yield. And the middle class responded exactly the way these institutions hoped they would, with excitement. And here is the thing, I am not going to tell you high-yield savings accounts are bad. They are genuinely better than what traditional commercial banks offer. Moving savings from 0.5% to 4.5% on a $20,000 balance is the difference between earning $100 a year and earning $900 a year. That is real money and it matters. But I want you to understand what is actually happening when a major financial institution offers you 5% on your savings, because the full picture is more nuanced than the promotional material suggests. Hidden gem. Number 4. When Capital One or American Express offers you 5% APY on a high-yield savings account, they are doing so because they need your deposits, and the competitive rate is worth paying to acquire and hold them. Here is what they do with those deposits while they hold them. They lend them out into mortgages, auto loans, personal loans, and most significantly, credit card balances. American Express and Capital One are among the largest credit card issuers in the United States. Their credit card portfolios charge rates between 19.99% and 29.99% annually. They are paying you 5% annually for funds they are deploying at rates 4 to 6 times higher. Additionally, and this is the nuance most people miss, APY means annual percentage yield. Your 5% is calculated and paid over a full year. The bank's return on deployed capital is generated continuously, daily, not annually. The math compounds in their favor in ways the APY comparison doesn't fully capture. High yield is better. High yield is not the complete answer. And there is one more element worth understanding about why these institutions have pushed high-yield savings accounts so aggressively. The longer your money stays in a savings account, the longer they retain control of it. Every feature designed to encourage saving, automatic transfers, roundup programs, savings goals, visual progress tracking, is also a feature designed to keep your deposits in their system as long as possible. Helping you save and benefiting from your savings are not in conflict for these institutions. They are the same objective. Right here, if you know someone who has been proud of their high-yield savings account, thinking they finally beat the system, share this video with them right now. Not to discourage them. They are doing better than most, but to give them the complete picture so they can do even better. Share it and subscribe if you haven't already. Everything we've covered is the system named clearly. Now let's talk about how the middle class stops being a passive participant in that system and starts being a strategic one. And the first thing I want to say clearly before we go through these moves is this. Do not close your existing bank accounts. I know what some of you are thinking. You are angry. You want to walk into your branch tomorrow and close every account. I understand that feeling completely. But closing a long-standing bank account has consequences you need to consider. Banking history and account tenure can factor into loan applications. Long-term accounts with positive history contribute to your overall financial profile. The relationship, even if it has been one-sided, has established value that disappearing from overnight would cost you. The move is not to leave. The move is to stop being exclusively loyal. Hidden gem number 5, 5 strategic moves. Move number 1, keep the account, change the role. Your existing commercial bank account stays open. It serves a specific and limited function, receiving direct deposit, paying bills, managing day-to-day transactions. That is its role going forward. It is not your wealth-building vehicle. It is your transaction clearinghouse. Nothing more, nothing less. Move number 2, open a high-yield account immediately. Your savings, every dollar you are currently holding in a traditional savings account earning 0.5%, moves to a high-yield savings account. Marcus by Goldman Sachs, Ally Bank, American Express. High Yield Savings, SoFi, and others currently offer rates between 4% and 5% with no minimum balance requirements, an FDIC insurance protection equivalent to your commercial bank. This is not complicated. It is an online application that takes 15 minutes, and the difference on a $15,000 savings balance is approximately $675 more per year in your pocket rather than theirs. Move number 3, explore a credit union. Credit unions are nonprofit financial institutions owned by their members, meaning you. Because they are not profit driven in the same way commercial banks are, credit unions consistently offer higher savings rates, lower loan rates, and lower fees than commercial banks. The average credit union savings rate is significantly higher than the average commercial bank savings rate. And because membership is based on community, profession, or employer, most Americans qualify for at least one credit union without knowing it. Search credit union near me or visit mycreditunion.gov to find options you qualify for. Jordan the nurse almost certainly qualifies for a healthcare workers credit union that would treat her deposits better than her commercial bank ever has. Move number 4, put long-term savings to work beyond the bank. For savings you won't need immediate or daily access to. Money that has been sitting untouched in a savings account for years. There are options that significantly outperform anything a commercial bank will offer you, and most people in Jordan's position have never seriously considered them. First, Treasury bills. T-bills are issued directly by the United States government, making them arguably the safest financial instrument in existence. You can purchase them directly at treasurydirect.gov with as little as $100 with no bank intermediary and no bank margin taking a cut of your return. Second, and this is where it gets significantly more interesting for someone in Jordan's position, brokerage platforms like Fidelity, Charles Schwab, and Morgan Stanley offer money market funds and treasury bond funds where yields can exceed 7% annually. Many diversified bond and treasury funds on these platforms have averaged returns well above that figure over time. This is not stock market risk. These are conservative, government-backed, or highly rated instruments managed by professional platforms. The same platforms where high net worth individuals and wealth managers park capital that is not needed immediately. The middle class has largely been told that Fidelity and Schwab are for wealthy investors. That is not true. These platforms are accessible to anyone, and the minimum investment thresholds are often comparable to or lower than what banks require for premium savings products. For money Jordan hasn't touched in 4 years, money sitting in a bank savings account earning 0.5%, while these options exist, the opportunity cost is significant and entirely correctable. Move number 5, treat every banking decision like a business decision. This is the mindset move that underlies everything else. Your bank evaluates every product, every rate, every policy based on what is optimal for their business. You should do exactly the same thing. Shop savings rates annually. Compare loan rates before accepting what your bank offers. Ask specifically about rate adjustments as a long-term customer. Sometimes simply asking produces results, because retaining a customer is cheaper than acquiring a new one. And remember, a bank that has held your deposits for 25 years without adequately compensating you for them has not been your partner. It has been your landlord, charging you nothing visible while profiting from everything you brought through the door. Jordan has 11 years of faithful banking behind her. Going forward, those deposits are going to work for Jordan, not just for the bank. Jordan didn't close her bank account. but she opened a high-yield savings account that same afternoon and moved $14,000 in savings that had been earning 0.5% into an account earning 4.75%. She found a healthcare workers credit union 3 miles from her hospital, and she set up a Treasury Direct account for the portion of her savings she hadn't touched in 4 years. Nothing dramatic happened. No crisis was averted. No emergency was survived. Jordan simply stopped letting her discipline fund someone else's profits and started making her own money work the way it always should have. The bank is not your enemy, but it is not your friend either. It is a business. And the moment you start treating it like one, shopping it, leveraging it, diversifying around it, everything about your financial picture gets cleaner. That is what Financial Methods is here for. Every single week. If this video opened your eyes, like it, subscribe, and share it with one person in your life who still thinks their bank is doing them a favor with that free checking account. One person. That is how this information travels to the people who need it most. The more you know, the more you grow. I'm Sage, and I'll see you in the next one. Next time, we are pulling back the curtain on something that costs the average American family thousands of dollars every single year without them ever writing a single check or signing a single contract. It happens automatically. It compounds quietly. And the people who understand how it works almost never talk about it. That one is coming up next.